All right, our next chapter is chapter 3, which is a bit of a legal crash course when we look at business form considerations and also tax and IP, better known as intellectual property. So there are 6 learning objectives. First is, what are the choices we have when we start our company in terms of legal form? Second is, what are their tax considerations, which are substantially different? Third is, what is intellectual property? We often think of these only as patents, and there's far more types of intellectual property than patents. So we'll go through that. This is essential for your planning and protection, and also for your conversations with eventual funders. Fourth is, what are the pros and cons of patents? Despite what you may think, it's not all good. There's some bad things about patents as well, and you ought to make your decision thoughtfully. Next is, what is the process by which you would take to get a patent? Again, many misnomers here, and we'll clear some of the common misconceptions up in this video. And last, how do you protect yourself and your company in terms of protecting your intellectual property from other people who may be trying to steal your idea, and how can you protect not only with contracts, but also with the approach you have in filings. All right, so we're going to go through this fairly complex grid, and I'll just set up the dimensions right now as we go through the rest fairly quickly. On the top, you'll see the considerations, the number of owners, how hard it is to start. Next is, what are the investor liabilities for the founders and employees? Next is equity capital. What are the sources that would be available if you were to use one of these forms of organization? And what is the requirement or implications on the life of the company, and also liquidity in terms of ability to get money out to the owners of the business? And finally, what are the tax ramifications for the choice of these forms? And down the rows, if you will, are proprietorship, which is sole proprietorship yourself, basically. Second is a GP, or general partnership. Next is an LP, or a limited partnership. Next is a C Corp, followed by an S Corp, and an LLC, or limited liability corp. And believe it or not, there are more considerations and more forms, but these are the predominant ones in both those regards. So let's start with number of owners and how hard it is. Sole proprietorship is one person, very low cost. In fact, you don't have to file anything. You could, to protect some trade names and fictitious names and things like that, but you don't have to. You could simply be a company operating with a DBA, doing business as. And this would be easy, low cost, no legal cost. Next would be a general partnership. This is where you have 2 or more people and they share everything. That's why they're general partners. And there's a little bit of time and cost. You, again, could do this in a bar on a napkin or just with a handshake. We don't suggest either of drinking while you're making the agreements or doing everything by handshake. So that's why we say that there are moderate time and cost, because it should be memorialized in an agreement, a general partnership agreement. It doesn't have to be complicated, but we need to set the expectations and who gets what, who does what, and how do you share things, namely money. Third is limited partnership. This is a little bit more complex, and you'll see why this is valuable in a moment, but it comprises of at least one general partner, and it could have any number of limited partners. And the big difference is in liability. This, since this is slightly more complex than a general partnership, would then have slightly more cost to form. Next is the most common form of company, which is a C corporation. These are kind of standard corporations in the United States that has normal corporate tax rates and laws. So this is very common. It's 1 or more people. You can form it and just own 100% of the shares, or you could have, in the case of, say, Google, millions of shareholders. And obviously more time and cost involved because it's a formal filing with the state, and there's more laws to consider as a bona fide C corporation. Next is an S corporation. S corporation is actually more of a tax distinction than anything else. A C corporation is covered by corporate taxes. An S corporation is still a corporation and has all the protections of that, but you elect what's called subchapter S, which gives this enterprise some tax advantages. And because it has tax advantages, there are limitations. So they cannot have more than 100 people. All the owners must be people, not other corporations or entities. So there are limitations because The intent of a subchapter S is to help form small businesses. The government and Congress tries to reduce the barriers for companies starting new businesses. So subchapter S provides benefits for small or family-owned companies, are commonly S corps as well. And finally, limited liability corporation. And more than one person, their language is slightly different. They're called members and not shareholders. The distinction or the use is typical for professional companies. So LLCs are often law firms, consulting firms, CPA firms, because they're owned by the people that work there, and they have very specific ways to divide up the money that is required or is paid out by the corporation. So this is the first dimension. Second is liability. If you are a sole proprietor, you're unlimited liabilities. Whatever you do, you can be sued for it because there is no entity to protect you. Second is a general partnership, which is no better. Although you have other people in your group, perhaps, each can be sued by the complainant or the claimant of damage. So it doesn't protect you from legal liability. And just because you have 10 partners doesn't mean that you're only 1/10 of the liability. It is unlimited liability. And this idea of joint and several means that one person could be held responsible to pay 100% of the liabilities. So this is a very dangerous form. Next is the LP. Here, the limited partners can only lose the amount of money that they have put in or have committed to put in. They cannot have any additional personal liabilities so long as they act like a limited partner. The general partner, however, is, as in the earlier case, has unlimited liability personally for the liabilities of the partnership. Next would be the corporation, the C corporation. And a C corp has a lot of protection. The shareholders cannot lose more than the dollars invested in the company. So this is why it's such a popular form, because people are not personally liable. Subchapter S still has the same protections as a C corp. Again, the distinction is more for taxation than liability purposes. And finally, same with LLC. LLC is a corporation, and therefore the legal protections of a corporation are provided to LLC. So the bottom three are all corporations, and the main difference is in how they're governed and how the tax is computed. Next is, where would you get money? Well, if you're a sole proprietorship, it's your money. General partnership, you can get it typically from a closed circle of people, yourself, family, and friends. Limited partnership, pretty much the same, but since there are some protections of liabilities, you may be able to induce other investors to enter as limited partners. C corporations, pretty wide open. Many people can be participating in it, and there are a lot of advantages to raising money from a C corp form A standpoint. Subchapter S is similar, but because of the limitations of who can be an owner, there are some constraints, and you can't have entities like VC firms or corporations or trusts be owners. And finally, LLC, similar to what we said above. Firm life and liquidity, proprietorship is you. So when you die, the sole proprietorship dies. Not to be morbid, but that's what it is. General partnership, typically, again, it is a collection of individuals. So therefore, when a partner dies, it may cause the dissolution, which means the breakup of a partnership, unless provided for otherwise. So partnerships can have things called buy-sell agreements. So as one partner dies, there is an agreement among all partners on how the heir would receive the benefit of the partnership, or it may, but probably would not, allow the heir's estate to become, or individuals from the estate to become a partner in the deceased person's place. Again, not usual, because that's playing with fire if we don't know who the partners are. Third, a limited partnership is similar, but is governed by the general partner. If a limited partner were to pass away, the rights can be held by the estate or held by the heirs. In this case of a corporation, unlimited life. Again, a major advantage for corporations. Corporations have been around in the United States for over 100 years, and hopefully some people will be alive that long, but probably not. So they have unlimited life, and the owners may transfer it. Again, a major advantage of a corporation is if you're a shareholder, you can sell your shares to another person, only limited by the provisions of the shareholder agreement and the corporation's rules. But in terms of legal possibility, it becomes a tradable security. Subchapter S is a little bit more limited because of its nature. It's a smaller closed group, so there may again be restrictions on who can be an owner of the stock and how transfer would occur. LLCs, same as a subchapter S. There would likely be limited rights for a person to sell to another person. And finally, taxation. Here are the big differences. If you're a sole proprietorship, you are taxed as a person. So you simply take all the profit from your business that you're running as a sole proprietorship, and it goes in your personal tax return each year. If it's a general partnership, the next two actually are similar in this regard. They're called conduits. Conduit is like an electrical conduit, which is a tube where the wires go through. So a conduit itself is not wire. It allows the wire to pass through. Same with tax. So as a conduit, the tax implications of the business of the partnership are passed through to the owners. So the owners will then pick up their share of the profits and then report it on their personal tax returns and pay taxes. So the advantage to this, even though it sounds complicated, is substantial. That means if you have a partnership and it makes money, there's no tax at the partnership level, but there is tax once at the partnership level. Big advantage here is what we call single taxation, and we'll discuss that further in a couple of slides. Corporation, all of three of these are corporations. However, from a tax standpoint, a C corporation must pay corporate income taxes, but both the S corp and the LLC behave like partnerships. They are conduits. So money again, or tax attributes, flow through the S corp and the LLC to their owners, and they pick up the share. So summarizing it, out of all these forms, only one pays corporate tax, the C corporation. All the others, the taxes are paid at the owner levels. All right, when you're a general partner, you have these rights and obligations. This is very important because it's serious business. Why? Because you're running the business. Your rights are you can do everything. You have full decision autonomy, so you could borrow money, you could pay bills, you could contract on behalf of the company. Basically anything that an owner can do, you can do because you are the general partner. Your duties is that you have to act in accordance with the partnership agreement, which means you're looking out for the benefit of your fellow partners, and you do your decision making as a fiduciary, which means on behalf of the company, not only toward your personal interests. If your personal interests are the same as the company, no problem. But if there is a personal motivation, you can be held liable if you act for your personal goals to the detriment of your partners. So it makes sense, right? A general partner, because they induce others to join, need to act as a partner and not as a single person because it's a partnership. Summarizing some of the key attributes, it's an easy thing to form, easy thing to control if you're the general partner. But the problem is to avoid it. I have been burned. I may share some of this if you're interested in class. I've been burned very badly by being a general partner one time in a real estate firm. And all my partners, we had 10 partners, everyone was a general partner, and we got into a little bit of trouble. And we all were personally liable for the debts of the company, both existing with banks and in the future, like with landlords. So this is really, really dangerous from a liability standpoint. And I strongly advise that you not form a general partnership unless you're absolutely sure of the risks and you're willing to take those risks. But I would strongly argue against being a general partner. All right, so the tax differences we talked about before. Here it is on a separate slide. Sole proprietorship, you're taxed once as a person. General partnership, it's a conduit. It passes through the partnership entity to the owners. Next is a limited partnership. Same thing, it's passed through, and it could be on a different basis since there are different rights between a GP and LP. There could be different tax allocations, we call it. C Corp, this is the one that's taxed. The US government likes this one because they make money from taxing corporations, but it's taxed twice. If you think about it, a corporation makes money. They pay taxes as a corporation. When the corporation pays dividends to its owners, the owner must take that dividend into their personal tax return and pay tax on that. That's why we call it double taxation. Once at the corporate level, once at the individual level, once they receive the profits, whether by way of dividend or when they sell the company, they would pay taxes. Next is an S corp. It's a conduit, acts just like a partnership, and you would pick up your pro rata share of the ownership and pay taxes once. Same with LLC. Each of the members of the LLC would pay taxes based on their share as distributed from the LLC to them as individual owners. The rates, I'm not going to have you compute rates because most of you will not be doing it. Some of you won't even be in the US covered by these laws. But I just want to illustrate how the structure of taxes work for corporations and individuals in the United States. The top section is for corporates, C corporations specifically. So you can see what we call a progressive rate. Progressive doesn't mean that it's nice. Progressive means that it gets higher as you go. But notice there's a little bump. So it goes 15, 25, 34, 39. So it goes up. Then it drops back down to 34, 35, 38, 35. Trying to understand why these rates exist, understand it comes from politicians. Politicians are looking at the distribution of companies in these various strata, and they're computing tax rates so that the U.S. Treasury coffers are full of money raised from corporate taxes. So this is a heavily legislatively determined policy and rate. The bottom section is the personal tax rate for single or married filed jointly. And what that means is if you're married, you would have a choice of filing separately or as a joint return for husband and wife. And you see the rates here, again, are graduated. And in this case, they just keep going up, right? 10, 15, 25, 28, 33, 38. And these have been changed recently by the tax policy of the current Trump administration. So tax rates have dropped in the last year.